Welcome to the Daily Consolidation, your 15-minute briefing on today's market action. We break down the day's most important moves on Wall Street, delivered right after the closing bell. Please note, this is an AI-generated podcast, and the views shared here are for educational and informational purposes only. Nothing we discuss should be considered personalized financial advice. Always do your own research and consult with a qualified financial professional before making any investment decisions. Now let's dive in.
Wow. Okay, if we had to pick one theme for today, it really felt like a valuation reality check, didn't it?
Oh, absolutely. After that incredible run we've seen, gravity finally seemed to reassert itself today, hard.
Yeah, it wasn't subtle. Felt like a really decisive risk-off move pretty much everywhere you looked.
That's right. It's like the market suddenly remembered valuations matter. The S&P 500, it closed down 1.17%, settling at 6,771.55. But the real pain, or maybe the real anxiety, was in tech. The Nasdaq plunged 2.04% to 23,348.64.
Ouch. And the VIX, that must have jumped. It certainly did. Spiked 13% today. Climbed almost to 19.40. So, yeah, fear definitely ticked up.
Okay, so let's try to unpack the psychology here, because that feels like the main story. We've had weeks where good news meant instant buying. Today felt different. What was the catalyst? What finally cracked that momentum?
I think it was a confluence of factors. You had these warnings from some pretty high-profile CEOs finally landing. At the same time, the market's internal structure was looking, well, vulnerable.
You mean those comments from Wall Street?
Exactly. We heard from Goldman's David Solomon, Morgan Stanley's Ted Pick, both at a conference, suggesting, a healthy correction wouldn't be surprising.
Talking about maybe 10 to 20% sometime in the next year.
Yeah, that was the range mentioned. And importantly, they framed it as normalization, not necessarily a super bearish call on the economy itself.
Right. More like, hey, things got a bit ahead of themselves. Let's cool off. Not a recession warning.
Precisely. It's like they were giving voice to that nagging feeling that valuations, especially in certain pockets, were stretched. And that message hit home because technically the market was already showing cracks.
Let's talk about that technical side. We've discussed market breadth before, how many stocks are actually participating. How bad is that picture right now?
It's pretty severe, actually. As of the close today, fewer than 38% of S&P 500 stocks are trading above their 50-day moving average.
38%? That's incredibly low, especially for a market that was recently near highs.
It is. It tells you the rally was getting narrower and narrower, really dependent on those mega cap, often AI-related names.
So when those leaders finally falter?
There's not much broad support underneath to stop the fall. That concentration risk, it played out today. When the leaders stumbled, the whole index followed pretty quickly.
And it wasn't just stocks acting this way, right? You said risk off across the board. That consistency is important.
Absolutely. Textbook stuff, equities down, particularly the growth and momentum names we just talked about. The U.S. dollar strengthened. The DXY index climbed about 0.30% to 100.17.
Which pressures anything priced in dollars like commodities and crypto.
Exactly. And we saw treasuries catch a bid, though maybe not as strong as you might expect.
Right. Let's touch on that. Where did the safe haven money go? Usually you see yields plunge in treasuries.
We did see yields drop, but it was quite modest. The 10-year yield fell just 2 basis points to 4.085%.
Only 2 basis points.
Yeah. Bit muted.
Yeah.
It suggests bond investors aren't hitting the panic button on the economy just yet. They seem more focused on longer-term Fed policy expectations. We can circle back to that.
Okay, let's do that. But first, back to equities and that tech sector plunge. Nasdaq's worst day since late October, you said. And over 80% of S&P stocks were down.
That's right. Just overwhelming negative breath.
Yeah.
And the paradox, as you called it, was seeing tech get hit the hardest despite many of these companies reporting strong results recently.
So today was purely about price. Valuation trumped fundamentals.
It absolutely seemed that way. Investors basically said, great results, but the price is just too high for this environment.
Palantir seems like the perfect example here, down over 8%.
Right. And that was after they beat estimates and gave upbeat guidance, specifically citing their AI business growth.
So why the huge sell-off then, if the business is good?
Because of the starting valuation. Palantir's forward PE ratio was well north of 200 times.
Wow.
Yeah. When you're priced for utter perfection like that, and the market mood shifts towards caution, those are the first stocks investors trim. That multiple becomes an anchor in a risk-off environment. It's just too expensive to justify holding for many.
And it wasn't just Palantir. Nvidia down over 3%, Oracle down nearly 4%. Just broad pressure on those high multiple names.
Definitely. A lot of profit-taking, deleveraging on anything that carried a significant growth premium.
And we have a test coming up right away, don't we? AMD reported after the bell.
We do. Crucial test. AMD's numbers looked strong. Revenue beat expectations, $9.2 billion versus $8.7 billion forecast. So how the market treats AMD tomorrow? If it gets punished despite those good numbers, that will tell us a lot about whether this negative sentiment is really dug in.
A key thing to watch. But it wasn't all doom and gloom, right? Some company-specific news still managed to shine through.
Absolutely. M&A is still happening. Denny's core shares just skyrocketed over 50% on news of a $620 million take-private deal.
50%.
Yeah, and Yum. Brands jumped over 6% on speculation they might sell off Pizza Hut.
So deal activity is still robust. That suggests underlying confidence from, corporate buyers and private equity, right? They still see value.
Exactly. It suggests they don't see the fundamental economy as broken, even if the public equity market is having a moment of anxiety about price.
Okay, let's use that point to pivot back to fixed income. You mentioned the bond market reaction was muted. 10-year yield only down 2 basis points. Why so calm when stocks were clearly stressed?
Yeah, this is a really important divergence to note. The bond market tends to operate on different timescales and different anchors. Right now, it seems firmly anchored by expectations around the Federal Reserve.
Still pricing in rate cuts.
Heavily. The CME FedWatch tool still shows, I think, around a 65% chance of a rate cut by December. Bond investors seem to be looking past today's equity volatility, viewing it perhaps as a valuation adjustment, not a signal of imminent economic collapse that would warrant a massive flight to safety.
And this relative calm in bonds comes even though we got some slightly weaker economic data today, the ISM manufacturing number.
Correct. The ISM manufacturing index actually disappointed slightly.
Yeah.
Came in at 48.7, expected was 49.3. So still in contraction territory, below 50.
Which is usually a concern.
It is, and it's an important data point, especially because, as you know, we're still dealing with this government shutdown, now 34 days in.
Right, which limits our visibility on other key economic reports like the official jobs data. Makes things like the ISM maybe carry a bit more weight than usual.
Precisely. But here's the key divergence for listeners. While equities are worried about price, the credit market seems relatively calm about fundamentals.
Ah, okay. Explain that. Credit spreads.
Exactly. Investment grade and high yield credit spreads, basically the extra yield investors demand to hold corporate bonds instead of safer treasuries. They remain pretty stable today. They didn't blow out.
And what does that stability tell us?
It tells us that the investors most focused on balance sheets and a company's actual ability to pay its debts. They aren't panicking. They seem to view this equity weakness as more about valuation getting stretched, maybe some liquidity adjustments, rather than a fundamental solvency crisis brewing.
So not a sign of widespread corporate distress in their view.
Not yet, based on spread levels. If we saw spreads widening out rapidly, that would be a much bigger red flag for the economy. But we're not seeing that signal from the credit market today.
That's a really crucial distinction. Okay, let's shift to currencies and other risk assets. You mentioned the rising dollar was a headwind.
Yeah, DXY up to 100.17. That definitely put pressure on dollar-priced assets.
Yeah.
Gold, for example, took a hit.
How bad was it for gold?
Fell about $68, down to $3,935, slipped below that $4,000 psychological level. It's facing headwinds from both the stronger dollar and the opportunity cost of holding a non-yielding asset when rates are perceived to be staying higher for longer.
But the really dramatic move today seemed to be in crypto, particularly Bitcoin.
Oh, absolutely. That was the main event in risk assets, I'd say. Bitcoin actually traded below $100,000 briefly, first time since late June.
A low six figures. That must have triggered a lot of stops.
You have to assume so.
Yeah.
It did close slightly above that level, around $104,577, but still down almost 3%. Ethereum got hit even harder, down over 6%.
Is this just retail fear, or are bigger players involved?
We're definitely seeing signs of continued institutional selling, or at least profit-taking. The U.S. spot Bitcoin ETFs saw pretty significant outflows again yesterday, about $186.5 million. That follows other recent outflow days.
So institutions are pulling back. And how's sentiment looking in that space now?
It's deteriorated significantly. The Crypto Fear and Greed Index dropped sharply, down to 36 today. That's firmly in the caution or fear territory, down from nearly 60 just a month ago.
From greed to caution pretty quickly.
Exactly. It signals traders are pulling back risk, likely deleveraging too. We've seen reports of large liquidations in leveraged positions recently. It feels like a risk reduction move is underway.
Okay, so after a day like today, with such broad selling, how are analysts thinking about the next few sessions? What are the likely scenarios?
Well, the most favored scenario right now, maybe around a 50% probability, is what we could call the consolidation scenario,
Meaning,
meaning the market kind of chops around here. The S&P 500 maybe trades in a range, say, between 6,700 on the downside and 6,850 on the upside, basically digesting today's move, waiting for more clarity, which is hard to get with the shutdown still on.
okay, sideways consolidation, what's the main risk scenario then, if things get worse?
That would be the correction extension scenario. Analysts might put about a 30% chance on this. It means today wasn't just a one-off reset.
And what would that look like, technically?
It would likely involve the S&P 500 breaking below that key 6,700 support level. If that happens, selling could pick up speed, maybe targeting the 6,600 area next.
And for Bitcoin?
That would probably mean failing to reclaim and hold $100,000 convincingly, opening the door to further technical selling, perhaps down towards the $95,000 level.
Okay, so those are the scenarios. That leaves us with some key questions to ponder, doesn't it? Thinking about what really matters going forward.
Absolutely. And the first one has to go back to where we started, market breadth. Will this really poor breadth, fewer than 38% of stocks above their 50-day average, inevitably drag the indexes lower?
Right. Can those few big generals keep holding the line indefinitely, or does this internal weakness have to resolve itself somehow?
That's question number one. And number two, focusing on those riskier assets. Was Bitcoin dipping below 100K just, noise in a volatile asset? Or is that technical break significant and likely to trigger more downside towards that $95,000 area?
Two critical questions. It really feels like the market's at a crossroads here.
I think that's a good way to put it. It faces a fundamental choice. Is today's action a sort of healthy breather? Just some profit taking within a bull market that's still fundamentally supported by decent earnings and stable credit?
Or is this the start of something more serious? The first real step into a more significant correction driven by these valuation worries and the clear technical deterioration we saw today?
Exactly. And the answer to that question is really what's going to shape the market action over the coming days and weeks.
That's all for today's episode of the Daily Consolidation. For more daily market analysis, subscribe, and we'll see you at the next close.